Hello, and welcome to Trestlebridge Capital's Know What You Own series. First, a quick word from our legal team. Leading today's discussion is Eric Jefferson, Managing Partner at Trestlebridge Capital, and joining him is Justin Newberg, Portfolio Manager and owner of Convergence Investment Partners, to discuss long-short equity investing. Let's get started.
Justin, really excited for our conversation today and appreciate you making the time to join us. As I mentioned, this was a series we created just to give clients a better understanding some of the underlying investments in their portfolio. I know with your role as portfolio manager, ultimately the end decision maker of what goes into these holdings, know that'll make for a very insightful conversation. So again, appreciate you taking the time to join us here today.
Happy to be here. Thanks for having me. I'm looking forward to the conversation.
Oh, great. Usually we'll talk about what a strategy is, how it works, why it fits into the portfolio. As a bonus for today, I think we're going to talk about not only long short as a long-term core holding in a portfolio, but why that's especially attractive in today's market environment. Going back to the beginning, tell us in your own words, we think about long short equity for folks that may not be familiar with that strategy. How do you define that?
So that's a great question. Really, what you're doing is you're taking both long and short positions at the same time. Essentially, you have a long book. This is the traditional way of investing. You purchase stocks that you expect to rise in price. Perhaps they're undervalued, or you think they're going to have exhibit strong growth in the future. Profits in this book are made when the stock goes up in price. Additionally, you'd also have a short book, which are stocks that you believe are going to move down in price. Perhaps they're overvalued, or you think they're poorly managed, or there's a threat to their future growth. And then the goal of this long and short being put together is to isolate managerial expertise. And the goal is to really try to generate alpha from stock selection and not just general market return. And it's also to try to reduce or hedge against overall market risk.
Oh, that's great. And mechanically, how does that then work at the end of the day?
What this is getting to is what they call the hedge ratio. So what happens is for every dollar that's invested, or let's say $100 that's invested, you can put a certain portion of that into your long portfolio. So let's say 100% of your invested dollar goes into a long position. You can then also create a short position for, let's say, 50 of that $100. So you'd have a long position of 100, a short position of 50, giving you a net exposure, long minus the shorts, of 50. Another term that's often utilized in the long short space is the gross exposure. And this is the sum of your long and short exposure. And the example I provided you, it'd be 150. So you take the long at 100, the short at 50, giving you a gross exposure of 150.
No, makes sense. And we think long term. So looking out over a period of decades, stocks historically are up 2.2 out of every 3 years. Traditional long only investing, you're hiring a manager, they're buying those names they anticipate to appreciate in price. And that, using your framework there, is 100% long on both the net and gross basis. Compare and contrast taking a long short approach compared to traditional long only.
Sure. So when we're talking about that, let's look at kind of some of the benefits that I see for long short investing. One of the biggest benefits to employing a long short approach to investing is either the enhancement of the sources of returns or increased alpha generation. So in long short investing, you can profit from both rising and falling prices. The manager is allowed to express both a bullish and a bearish view on a stock, and it basically doubles the alpha opportunities for a manager. With long only investing, you can really only profit from stocks that move up. It's very difficult to express a bearish view on a specific ticker. Basically, all you can do is either not take that position or underweight it. And that can be extremely challenging to do if that position has a 10 or 20 basis point weight in the index. Additionally, with long short investing, you're able to better manage your market exposure. In a long only portfolio, you're either fully exposed or let's say 90 or 95, depending on how big the cash position is that long manager is taking. With a long short strategy, you can handsomely adjust your net exposure by adjusting your long positioning or your short positioning. Another benefit of long short investing is the improved downside protection and potentially reduced volatility. A short portfolio can act as a hedge. Oftentimes, it will offset some of the moves and drawdowns that come from the long side. With the long only investing, you're pretty limited as far as your downside protection is concerned. Basically, portfolios are going to fall with the market. And the same thing with volatility, right? By having that short position, you're able to minimize some of the volatility. And with the long only portfolio, basically you're fully exposed to the volatility of the broader market.
Yeah, I mean, obviously, long term market is up more than it's down, but as we all know, those down years, particularly the sharp drawdowns, very painful. And clearly, this is designed to offer somewhat of a buffer relative to just that long only beta of one market exposure. I think that sort of takes us to the next question of from a timing standpoint. And nobody here is trying to time the market per se, but we do think following the sharp double digit drawdowns in 2022, market has had a very strong recovery in the last handful of years, 20+% returns for the last three, at least on track if year to date gains continue. Valuations have obviously ticked a little higher. Tell us, with that in mind, what makes this particularly attractive opportunity given the current time horizon or current environment for folks that may be taking more of a tactical approach?
That's a really interesting question. When you're looking at long short investing, there's different hedge ratios in the resulting strategy that you can have. So you could have a more market neutral approach where you'd have again, 100% long or maybe 80 or even 90% short. In that strategy, you're trying to generate a return that's basically independent of the market. What we do at Convergence is we do more of a long bias strategy. Our net exposure is about 65%. So we are obviously believers in the fact that the market tends to move higher over the long term. So we want to maintain that long bias, which gives us a nice tailwind for long-term investing. However, in addition to that, there are three major items that I think make long short pretty attractive in this current market environment. The first is there's been, over the last 5 years or so, an increasing return to a focus on stock picking or alpha. We had basically a decade of beta dominance where interest rates were basically at zero and market moves were basically being pushed by lower rates, lots of cash in the market, monetary policy. These were all just pushing all stocks higher. Over the last 5 years, we've really seen a return to fundamentals, given a little bit more normalization of interest rates, kind of the post-COVID environment. People are being a little bit more discerning with their stock selection. Additionally, economic uncertainty can be better for active managers. I'd say the last couple of years have been a little bit more uncertain. Again, it just hasn't been that pure beta dominance that happened during the ZIRP or zero interest rate period. We're also starting to see the company fundamentals are starting to matter again. Another major benefit of long short investing right now is the attractive short selling economics. In a zero interest rate environment, when you short a stock, you basically borrow it from someone else, go out to the market, sell it, and you receive that cash today. Now that cash is put into basically an investment where you can earn a return. In a zero interest rate environment, which we had for about a decade there, and after 2010 at Convergence, we had to pay money to hold that cash short because interest rates were so incredibly low. We actually had a negative rebate. Now we have actually a pretty strong tailwind. So it's basically Fed funds rate minus a very de minimis spread, but this affords a long short manager a nice tailwind to their portfolio returns. And then lastly, in an environment of increased market volatility and increased stock return dispersion, there's a lot more opportunities for an active manager or a long short manager to generate alpha for their clients. So again, with some of this uncertainty, as far as inflation, as far as interest rates, geopolitical stresses and events, this all leads to higher volatility and more intra-stock dispersion. So in other words, all stocks aren't moving in lockstep, either up or down. All of these performance differentials give a slight edge or a slight opportunity to a strong manager in the long short space. So we're pretty excited about the return to fundamental analysis and fundamental stock selection, which is basically at the core of what we do at Convergence. Our basic philosophy is that stocks with strong and improving fundamentals will tend to outperform the market, and stocks with weak and eroding fundamentals will underperform the market. So our long book is comprised of fundamentally sound stocks that have done well in the past, and we think are going to continue to do well, and the exact opposite on the short. So our stock selection process should and has done quite well in the past few years with this, again, return to fundamentals and the increased market volatility and dispersion.
Now, 2 points you made there. One, we talk about zero interest rate environment. If we make the analogy, that's fertilizer. That fuels both the weeds and the grass.
That's
obviously
true.
We're now in an environment where it's no longer a stock market, but rather a market of stocks. And to your point, much greater opportunity to add excess return owning those names that are fundamentally strong as opposed to simply buying the index for a few basis points and taking the market return that's offered. So greatly appreciate that. As we actually think about the mechanics of the strategy, how do you decide what names ultimately go into both that long and that short bucket?
That's a big question. Let's take a quick step back and just talk about what the long short strategy is at Convergence. We currently run it at about 115% long and 50% short. So we are in that long biased camp. As I mentioned, giving a net exposure of about 65%. We are US equity only. We invest in the top half of the US stock market, basically stocks that are about 3 billion and up in market capitalization. We invest across all industry groups and sectors. The alpha that we seek to deliver is from stock selection of both longs and from shorts. In order to do that, we employ a very systematic approach. We really have a heavy focus on repeatability. I often joke that it's not that difficult to find a very strong track record, but it's very difficult to find a track record that's likely to persist into the future. And I would argue a more systematic approach and an approach based on repeatability, again, is more likely to repeat in the future.
You're absolutely right. No such thing as a bad back test, but
That's true.
How appropriate or realistic is that continued performance? And you guys obviously have a very good track record, even despite the net more conservative allocation in comparison to just simply owning a long only index. Know that performance speaks for itself. And I think that at the end of the day, probably just a function of all the work you and your team does, trying to identify those names that are fundamentally strong and, again, avoiding or even profiting off those that aren't as well positioned.
That's true. That's very true. So another advantage for us is I like to joke that we operate at the convergence of quantitative and fundamental analysis. Using the tools from quantitative analysis, we're able to be very unbiased and systematized. We're also able to incorporate data more quickly, and we're also able to provide analysis on a broader coverage of stocks. So we actually score the Russell 3000 or the top 3,000 stocks every single day. And what we do is you mentioned this earlier about how our stock selection works. We basically rank every single industry group. So there's 25 industry groups. We rank each industry group using an industry group specific model from most attractive to least attractive as a long. And then we do the same thing again on the short side of the equation. We have, again, 25 distinct short models where we rank stocks from the most attractive to least attractive as a short. I would say some of the failings of short managers, maybe around the turn of 2000, what they would do is they would sort stocks from most attractive to least attractive, go long the top and short the bottom. And what drives a long is very different from what drives a short. So you actually have to have, and we do, autonomous models for the long and short, again, for each industry group, which really allows us to hone in on the drivers of a strong, attractive long, which we tend to be in for a year or maybe even more. And we want to identify a strong or attractive short, which we tend to be in maybe closer to 3 to 6 months.
Oh, appreciate that. And can you
Sure.
speak of some of the different themes, factors that are populating the more attractive long names and conversely, those that are screening as a more favorable short? As you think about market, obviously ebbs and flows and different styles, approaches, different sectors and industries of company come in and out of favor. Any sense of what's driving both those long and short positions today?
Sure. So at Convergence, we use 15 signals or factors for ranking all of our stocks. I like to group those 15 into 5 broad categories. So we have some value flavored categories, we have growth, we have quality, we have risk and momentum. Over the last few years, leading up until basically the turn of 24 to 25, momentum has been a very important signal for stock selection. What's very interesting is the stocks that have had this very strong momentum have also had some very strong growth and very good quality characteristics as well. So there's been a nice overlap of all of these signal scores. And that's provided our approach to fundamentally superior stock selection allowed us to deliver some very strong returns over the past few years. But at the start of 2025, the momentum rally really did a U-turn. That was a challenging environment, and trying to make those rapid factor changes or signal changes and try to forecast those is extremely difficult. It's just not something that we try to do at Convergence. However, we do score the market environment and say, okay, what is working, what isn't, and we'll rotate to those factors that work. But I want to use that word rotate very carefully, and that we rotate deliberately over time as opposed to rapid changes in order to make sure that we're not going to get whipsawed by a market change.
Absolutely. And shifting gears or taking a step back, we do think when you make changes to a portfolio in a traditional structure of a mutual fund or even a separately managed account, obviously there are some taxable considerations that the end investor may be subject to. Tell us how that works a little differently being in an ETF wrapper.
Sure. So, full disclosure, we were a limited partnership from about 2006 to 2009. 2009, we launched a mutual fund. We converted from a mutual fund to an exchange traded fund on February 22nd of 2022. We're big fans of the number two. Anyway, we were really pleased to make that transition. From a tax efficiency standpoint, it's really fantastic for the end user. We are, through the miracle of Create Redeems, able to drastically reduce, if not eliminate, any distributions from capital gains. In a mutual fund structure, we were obligated to do those distributions, and those can result from large selling from another investor in the mutual fund, can force a manager to have to trim some stocks and realize gains that they didn't necessarily want to have to realize. And unfortunately, those tax realizations are pushed out to all investors equally. In the exchange traded fund, that doesn't take place. So it's a much more tax efficient vehicle for the end user, for the investor. Additionally, the operational benefits of an exchange traded fund are really fantastic. Cashiering is much easier to manage. It's just a more modern vehicle. And Dave and I are both really pleased with how efficient and fantastic this has been for our end users from an operational and from a taxation standpoint.
As one of them, can't thank you enough for making that change. And again, we think about taxes, there's plenty of complexity there to begin with, never mind having to plan or in many ways react to unexpected tax distributions headed your way simply based upon the behavior and decisions of others. Furthermore, when there are sharp periods of volatility, that's often when you see investors will make those portfolio reallocations, and nothing worse than in a year where overall assets are negative. On top of that, there comes a unexpected tax bill. For folks in my seat, I know that creates some very difficult conversations. Again, one of the many benefits of the ETF structure, and not surprisingly, we look at a lot of the data that disproportionately tends to be where a lot of those flows are going for all the reasons that you mentioned, including a handful of others as well.
That's true. The fees are lower in the new ETF structure. And then, of course, the intraday liquidity can really make things easier if you want to make a decision in a portfolio for you guys.
Awesome. So last question, appreciate all the time. You work with a lot of folks on the allocator side. So putting together portfolios, know we've had frequent conversations over the years. From your perspective, would be curious, where do you see people put this in a portfolio? Where is it funded from? And again, how does that work in conjunction with other holdings various portfolios or models may include?
Right. That's a great question. And we actually do get that quite a bit. People want to figure out how to use it. A lot of times an advisor will call me and already have an idea of where he or she wants to use it. But in general, I'd say one of the bigger uses is it straddles right between your equity and your fixed income buckets, with a little bit more of a lean towards your equity piece, because it is a little bit higher beta product than maybe a market neutral or a pure global macro or something to that nature. We've also seen some advisors who have an alt bucket. And so they'll put it in that, or they want just a distinct alternative portfolio, and it'll just be a piece of that. We've also seen some advisors who will use it as just a standalone allocation in a portfolio, just as a one-off account for a client. They want to have something that's going to maintain exposure to the market, give a little bit of protection on the downside, just a little bit more juice to their cash.
And no right or wrong answer at the end of the day. I'll share, we're very similar. We hold this in our all equity models because, again, the performance has kept up with its benchmarks, and you do have that inherent sort of tail risk downside protection component to it with that lower risk profile. But agree, definitely when you think fixed income hasn't done a ton for the last handful of years, and obviously in 22 that was a pretty big headwind. Being able to have that lower risk profile, I think, allows folks in my position be able to fund that from both the stock and bond sleeves. Again, blending the two, offering a smoother, more consistent ride. But still, as we look at the numbers, one that has certainly participated throughout both good markets and bad.
That's true.
Justin, this was great. Any final thoughts? Anything that we didn't get to throughout the course that you'd want to quickly address?
No, I welcome everyone to visit the Convergence webpage, learn about the product. I'm more than happy to jump on a call to have a chat to get you more familiar with the product. I really enjoy what I do. Dave and I have been working together now for almost 16 years. We have a very intense focus on delivering outstanding products for all of our clients. Just always here to be available for anything you guys might need.
No, greatly appreciated. And that was something that was very obvious the first time we connected. You're very passionate about what you do. And that shows up not only in the conversations, but more importantly, in the results that you guys put up. So keep up the good work. Greatly appreciate everything you do and for the partnership as well.
Thanks. Anything I can do to help you guys out, just let me know.
Appreciate it.